Report 10/10/2025. Okay. Right. So today I want to talk about this particular thing. Right? Gold. Gold at 4,000. So what's driving it and what could come next? Right? So gold has just printed a historic 4,000 per ounce on October 8, 2025, extending a year of relentless higher highs. Now, price have soared more than 50% this year. The surge cements gold's status as the 2025 best performing major asset, outpacing US stocks and cryptocurrencies as central banks, sovereign funds, and retail buyers rush to shield their portfolios from market shocks. Now, why is gold rising? I think we have covered that in previous, but there are a few more things that happened recently. So I'm covering as part of this as well. The first of all is the dollar erosion rates and tariffs. This I've covered in the past. The US dollar fell roughly 10 to 11% in Q1 2025. Its worst first half since the early 1970s, lowering the opportunity cost of holding non-yielding assets like gold. The new tariffs have also stoked imports. Okay. Price and inflation concerns reinforcing currency hedging flows into bullion. Okay. The next is this data blackout and fiscal angst. Now, the ongoing US government shutdown has delayed economic data, prompting investors to rely on alternative indicators. Behind this shutdown, the deeper problem is fiscal. It is happening in the US and around the world. Public debt levels are unsustainable. To reduce debt and avoid currency devaluation, countries will need to raise taxes and cut spending. That means political parties will have to clash over how to manage an ever-shrinking budget. Now, this is a big issue that needs to be dealt with, okay? Because if they, both of this will increase the value of gold, currency devaluation, as well as the increase in debt. Okay, it already happened in the past, in 1929, if I'm not wrong, and that time, gold price increase. So if you have both or either one of this, then that's not good for the economy. But for gold, yes, it's a big thing, right? So that's why this is something issue that may not happen right now, because there's still room for the US to maneuver this, but in the longer term, it's not going to be easy. That's why you're going to see more shutdowns happening, and political parties clash over these kind of things. And it's just like the next president is going to face a shrinking budget, and it will come to a point where they cannot spend. So either these two, if they don't manage it well, reduce the debt, then this will come next, right? There's also this defensive hedge while equities are rich, whereby global equities remain very high, yet allocators have been adding a defensive slick, namely gold alongside stocks. This is visible in flows and in price action, with risk assets up and gold up, a hallmark of hedging for risk management rather than fleeing to cash. Okay, so it's just about managing their risk right now, both things, buying it at the same time. And then there's also central banks buying inflows plus the ETFs as well, getting in the gold. So central banks are still buying. The People's Bank of China has reportedly several months of gold additions in 2025. At the same time, the exchange traded funds that hold bullions for investors are taking in new money. In September, Asia drew about $2.1 billion of inflow led by China and Japan, and India recorded a monthly record. Together, official buying and fund inflows create steady financial demand that can move prices, especially when momentum is already positive. Of course, there are other issues that we discussed in the past, whereby it is just the central bank reacting to the way how the Europe, and the US sanctioned the Russia during the war, and basically what you call freeze all the Russian money that is in US dollars. And that really spoke a lot of nations like China, and said, hey, that could happen to us as well. I think we need to find somewhere where we can protect our money, and that's where gold came in. Okay, so now the question is this: will gold rise further? A scenario map. Okay, now let's look at the first thing first. Okay, these are the scenarios. US 10-year real yields. Now, gold is most closely tied to real yields, which are bond yields after subtracting inflation and are tracked with treasury inflation protected securities known as TIPS. Now, when real yield fall, the opportunity cost of holding a metal that pays no interest also falls. So, demand for gold usually rises. Over many years, a change of about 1 percentage point in 10-year real yields has lined up with an opposite move of roughly 18% in the gold price. From where we are now, a decline of about 0.5 to 0.75 percentage points would be consistent with low double digits upside for gold. So if real yield move up towards about 2.3 to 2.5%, the rally would likely slow or give back some ground. Okay, so this is one. Number two is a dollar path. If the dollar index, known as the DXY, resumes a broad decline driven by policy, interest rates, and trade, that supports gold. A broad dollar rebound based on stronger relative growth and higher rates would cool the metal, aka gold. Okay, that's dollar's path. Now, as for flows, as in the money flows, ETF holding matters. Steady monthly inflows, especially in North America and Europe, tend to extend trends, while abroad outflows are an early warning. Central banks matters. Watch the monthly purchase disclosure, including from the People's Bank of China. A slowdown would remove a steady bid in gold. Okay. And then we have also policy and politics, the timing of a shutdown resolution, the pace of Fed's cut, and any new tariff actions shape inflation and currency path. Those path tilts the odds for gold either higher or lower. So the base case for the next 3 to 6 months, if the Fed delivers more easing and the fiscal debate drags on, while real yields drift lower and ETF and central banks flow stay positive, the balance of risk is mostly higher from 4,000. Think of an extension of trend rather than another vertical spike. Okay, it's not something spike and just go up. It's just an extension of a trend. Helpful signals including falling TIPS yield, net ETF inflows, and steady central bank purchases. So you got to look into this in the next 3 to 6 months. But the rest have to play a role as well. Now, for a bull case, is a faster drop in real yields, a renewed dollar slide, a geopolitical shock, and continued official buying could push price discovery towards the higher target some banks expect in 2026. Some of them are touting something like 5,000, that kind of thing. But it's not something that can just go there. You need to have the right combination happening as well. Now, for bear or mean reversion case, a dollar rebounds, stubborn real yields, ETF outflows, or a quick shutdown resolution that restores macro visibility could trigger a pullback from overbought conditions. That will be a healthy reset within a longer trend, but uncomfortable for late buyers. If we're jumping right now, it's not going to be fun. Okay. previously when gold was in a bull run, in an uptrend, many investors got in late, and it took them more than 10 years just to break even. So it's not going to be very, very fun. Yeah, it will go up eventually, due to how things are when you have fiat money printing. Okay, but it can take some time if you're caught out. So let's see. Okay, so monitor these areas, that I've just mentioned, and that you would have a pretty good idea where gold could possibly go. With that, that's the report for today.